Good morning. Let's talk a little bit about Business Finance Chapter 2. So again, early on I'll tell you for Chapter 2 here, this could be kind of optional if you want to listen to and watch this or not. If you feel confident reading the chapter, doing the quiz on your own, feel free. This is pretty much a review of accounting stuff. If you've glanced through the chapter, you probably already know that. For those of you that like to listen to these videos or find them helpful, this is for you. When we get to next week, however, when we start some Chapter 3 stuff and we get into more of the quantitative types of things, tune may change. You may find it much to your benefit to listen in on these and take advantage of working through some of the problems and whatnot that are very similar to what you guys will have assigned. So here we go. Maybe here we go. Come on, PowerPoint, open up. Well, it's gonna be slow. I think every time that I open up this BB flashback, it gets very slow like this. So perhaps I'll pause it while we move forward here. Okay, I've tried to kind of close everything else down pretty much on my computer, so hopefully this will work a little bit. We'll see here as I try to get this opened up and walk through some of this accounting stuff a little bit. Apologize for that. I just think that my old computer just isn't quite up to the task when you open up something like that flashback, that BB flashback, because it tends to use a decent amount of, must be CPU or whatever. So some basic financial statements, certainly, that we're going to look at, and look at a lot of stuff when we go through the various chapters. Income statement, of course, statement of retained earnings. We don't spend a lot of time on that, but some, yep. The balance sheet, obviously. Cash flows are huge, of course. So what's the income statement? We use that to measure profitability over a period of time. It can be annually, it could be monthly, quarterly. We actually got what was called a daily statement of condition when I worked at the bank, that showed us on a daily basis, how our income had changed. Also actually updated our balance sheet each and every day. So and believe it or not, information like that on a daily basis can be kind of helpful when you're making some planning or making some adjustments as the year goes on, etc., or in a case when you get to be a bigger organization, just to see if something goofy shows up, and some of those things could happen if you have somebody too that's maybe embezzling or something from you. So by carefully monitoring those things, you can sometimes catch those things early. Okay, so sales, right? We have that. Sales or revenue. Okay, revenue is synonymous with sales. Minus your cost of goods sold equals your gross profit. Okay. Gross profit minus expenses equals earnings before interest and taxes, or EBIT, or we also would refer to that as operating income, right? Then we would subtract our interest, and we'd end up with earnings before taxes, and then ultimately subtract the taxes, and we end up with our net income, earnings after taxes, right? Pretty basics again, just a refresher from accounting. Here's an example, right? Pretty clear. It's a basic example. Obviously, when we get into more complicated things, we break down a lot of our operating expenses. Might even break down our cost of goods if we've got several different categories of goods that we're actually selling. So, return to capital. Three primary sources, right? Bondholders or debt holders, creditors, they receive interest. That's all they receive. That's one of the reasons debt's preferable, because they're just lending you money, and that's all they get back, and they don't really It can't really exert any other influence over your operations, right? Preferred shareholders receive dividends. Said dividends. Preferred stock, and we'll talk about that as we go through class often, is that preferred stock is not used very often. It's just not a vehicle that's really popular with companies themselves. And then common shareholders, they're the old owners of the company, right? It's no different. A lot of farms and ranches in this area are C corporations, and they're owned by the family, right? They're the shareholders. But that's no different than me owning stock in Microsoft or Google or Apple, right? I'm an owner of Microsoft, Google, and Apple. Granted, my percentage of ownership is just minuscule, but I am nonetheless a owner of that company, right? Earnings per share is a huge deal. Increasing earnings per share is what you always want to see, right? It's just a huge deal. You want to see that improving year after year, right? And it can be paid out in dividends or retained by the company, and we'll see that with a number of different companies. It's always interesting to look at. Growth companies typically do not pay out dividends, and what might be an example of a growth company? One I'm going to look at here in a little bit is Under Armour. Okay, and we'll take a look, hopefully, if the computer's quick enough that we can, right? But another company that has never paid a dividend, and you guys have had me for other classes know I like to talk about Berkshire Hathaway. Okay, it's an old, established company. It's a conglomerate. It's got investments in BN Railroad and Dairy Queen and Brooks Shoes and all kinds of different things, right? But it doesn't pay a dividend. Well, and there's a lot of reasons for that. We'll probably discuss some of those as the class goes on. So our statement of return earnings looks at something like this, right? We have the retained earnings that we had at the beginning of the year, the earnings that we made, earnings after taxes or net income during the year, minus what we paid out in dividends, and hopefully we would have an increase in our retained earnings or a capital account. It's part of our capital account, right? So it shows the disposition of earnings, or what do we do with our earnings. Certainly we can pay dividends, but also retain them for future growth, hopefully. Okay, price to earnings. You guys probably aren't that familiar with this term, and it's oftentimes referred to as just a multiplier, okay, or multiple. And this has to do with how a stock is valued relative to its earnings, and it's always kind of interesting to look at. You'd sometimes say intuitively, if you looked at this, you would say low price to earnings makes that company maybe more valuable as an investment, and a high price to earnings means that there's more risk. And those are kind of some general statements that are maybe kind of true, but sometimes you got to look a little deeper to really kind of figure that out. But I like to look at the price to earnings ratio more in terms of how the market as a whole is valued. And I go back, and most of you guys don't remember, but in the late 1999-2000 time frame, we had what was called the dot-com bubble. The stock market got terribly inflated in terms of values with especially dot-com companies. Anything that was a dot-com, the internet was just kind of really coming into a fold. It was just valued at just unbelievably high multiples or high-priced earnings ratios. And the market, the S&P as a whole, got up to somewhere around 24, 25 times earnings, or the PE was 24, 25. It was a time when the guy who was the chairman of the Federal Reserve at the time, Alan Greenspan, in fact said, the market's experiencing irrational exuberance. Those are really famous words. You can look them up, and I practically guarantee there'll be a picture of Alan Greenspan there. And it was true. Then it busted, the bubble burst, and kind of everything came back to light, to realism, and a lot of those dot-com companies fell by the wayside. I mean, it was to the point, it was so obsessive almost that if you just had an idea of something that might work on the internet, and you posed that idea and you went public, you would generate all kinds of money. And there were a lot of people that did just that. And basically, they had no substance. They really had no business model or anything. A few companies that came through that, okay, Google being one. Google was originated, somewhere back in that time frame and actually came through, but they had a real business model. So it was kind of an interesting time, and again, the overall market was 24, 25. I forgot to say that typically, the S&P, the overall market's more like in the 15, 16 has kind of been average, 14, 15, 16, kind of in that area. We're right now, I think it's 17 or 18, somewhere in that area. And so it's maybe we're a smidge overvalued, we'd say, but maybe not. Okay, we're certainly not the 24, 25, but price earnings indicates expectations about future of the company, some factors, right? Earnings, sales growth, risk, debt, equity, certainly dividend payment, management quality, etc. It allows a relative market value comparison of many companies, and that part's really true, and that's why it's kind of important, especially when you have companies that are in similar industries, right? If you compared Ford and GM, they're very much in similar industries. Burger King and McDonald's, right? Is one overvalued compared to the others, maybe. Firms with higher expected returns generally have higher PE ratios, generally. And price earnings ratios can be confusing, right? Drop in earnings may not match magnitude of fall off in earnings, which causes an increase in the price to earnings ratio. A drop in the earnings, I think that's supposed to be maybe a drop in the price, may not match the magnitude of the fall off in earnings, which causes an increase. I think that should be drop in price. Here's some examples, but I'm gonna hopefully, if I can get out of here, if it's gonna let me, quickly, briefly, and I'll go look at some real life examples if I am allowed to, if my computer will come to an agreement here with me. Apologize for this being slow. I'll try to, okay, sure, now it pops up. I clicked on one here, and a couple companies that I think are pretty similar in terms of what they sell and whatnot is Nike and Under Armour. These are for Project 2, and you guys do your project about writing up a public company and what you think of it, etc. Nike and Under Armour are oftentimes picked by college students because it's stuff that you wear, right? It's shoes that you have, it's apparel that you wear, it's all those types of things. Now, granted, Nike's more of a shoe company and Under Armour's more of an apparel company, but they're both actually striving to get into the other business. Under Armour, I think, is working on shoes and offering shoes, and Nike, on the other hand, does quite a bit of apparel anymore. Okay, so anyhow, I kind of wanted to take a look at this, and the forward PE, or forward price earnings ratio, for Nike is 23.4. Remember, I was talking about how the rational exuberance for the market as a whole, we were at 24, 25. So you'd look at Nike and say, "Ooh, gosh, is it overvalued? Maybe is the price too high?" What do you think about Nike's prospects for growth? Okay, and the market here is telling you that they think Nike is going to continue to grow quite a bit, and when we get into Project 2, we'll look at some more of those dynamics. But if I come up and I look at Under Armour and try to compare it with Nike, remember 23.4. Also look at the price to book, 7.1, price to sales 2.9. Hopefully we can get to Under Armour here and make a nice comparison. Oh golly, I might have to start using my tablet to make these recordings. We'll see. Okay, Under Armour's coming up slowly but surely. And remember, Nike was forward PE of 23.4. Look at, if we thought it was overpriced, what do we think of Under Armour? Okay, 44.9 in the forward. What it means by forward priced earnings is they're using next year's estimate for earnings. Companies usually put out some projections and whatnot. If the companies don't analysts well, there are people that work for Goldman Sachs, JP Morgan, Morgan Stanley, they'll do those. And remember, the price to book for Nike was 7.1 and price to sales was 2.9, if I remember right. All much bigger numbers for Under Armour. So what's that tell us? What do investors have? What are they thinking about Under Armour? Well, their expectation is that Under Armour is gonna grow faster by far than Nike, actually, and it might. Okay, it's a much smaller company at this point in time. Nike's kind of mature, right, and may find it more difficult to grow in terms of percentage, right? Absolute dollars, Nike may grow much more than Under Armour, but in terms of a percentage, it may be more difficult. And by that I mean, I think Under Armour's total sales are somewhere around $3 billion, maybe something like that, right? And yet Nike's total sales might be like 50 billion, right? So Nike might grow its sales next year by $3 billion, which would be a 6% increase. If Under Armour grows their sales by $3 billion, it's a 100% increase, right? And so sometimes those comparisons are kind of interesting and kind of odd. But if you're an investor, you want that 100% growth. I mean, that's going to be more important to you, right, than the 6% growth that Nike might experience. So all kinds of great stats and stuff down here. Yeah, here's what their revenue is, about $2.3 billion at the end of 2013. Probably don't have 2014 numbers yet because their annual report hasn't come out. But we'll look at a lot more of this when we get to Project 2. So I just kind of wanted to show you what price to earnings ratios look like. Okay, back at it here. So hang on a second. I got a student, so I'm gonna pause. Yeah, come on in. I'm recording, so I gotta pause. All right, sorry, had a little interruption there. We'll try to see if we can get back into her here now. And again with my slow computer. Let's see if we can get back into her. Okay. And this is some examples that, just kind of showing how they change over time and how the expectations of a company, as it gets more mature. Believe me, probably 15 years ago, Nike had price earnings ratios that were similar to what Under Armour's are now. But as the company's matured, those have kind of changed. So, okay. On the other hand, if you took a look at a company like Berkshire Hathaway or Microsoft, you'd probably see price to earnings ratios more in that 14 or 15 to 1 range, right? Okay, limitations of the income statement. Income gain loss, yeah. Stockholders may perceive much smaller gain or loss from actual day-to-day operations, and kind of what they're telling you there is that over certain periods, it's difficult to tell, and yet we're a real short-term society. If a quarter's earnings don't come in for a company, the poor CEO might just get crucified. Right, it becomes difficult at times, and day to day, we're such short-term folks, and we look at that, and yet, having a long-term outlook is actually probably the better way to do it. So, flexibility in reporting transactions, yeah, there's a lot of gray areas in terms of our accounting and whatnot. There's a lot of black and white what we can do, and certainly we can't do illegal things, but there's things that we can do, expenses that we can take. It's no different. Again, look at my brother-in-law's a farmer, right? And if he had a pretty good year, guess what he does? He goes out and buys all kinds of his fertilizer and chemical and those seed, whatever he might need for the next year. He buys it before his year end so that he can bring expenses back and avoid taxes, right? And that can certainly affect his income. In his case, he's trying to lower his income. What happens at a bigger level is kind of the opposite. A CEO that's maybe trying to hang on to his job, his or her job, might try to load income up and defer expenses. And you can do some of those in similar fashions, right? So the balance sheet, that's a point in time. What's a company look like at a point in time? That's kind of the main thing there. What we have for assets and stuff. And items are stated on a cost basis rather than on current market value. So that gets to be kind of interesting. For example, real estate. You might buy real estate. Real estate tends to appreciate slowly, but it tends to appreciate, right? Versus equipment and whatnot that tends to depreciate. Well, real estate, though, like a house, your house, if you owned it as a rental house, you could actually depreciate that. So you might buy the house for $100,000. 10 years from now, your cost basis, what they would call it, would be $50,000, say. But in that same 10-year period of time, your house may be worth $150,000. You might be able to sell it for $150,000. Okay, so that's kind of how that whole cost basis things work. On the other hand, your equipment, okay, you buy it for $100,000 and you depreciate it over 5 years, so $20,000 per year. That's real rough, easy look at depreciation. And over that time, over 2 years, we say the equipment's worth $60,000 on our books. That becomes our cost basis on our books, right? The market value of the equipment may be more or less than that, but we depreciate it based on what the government or how the government tells us we can. And actually, depreciation is one of those categories that Congress actually likes to fiddle with quite a bit. So, balance sheet. Items listed in the order of liquidity means we have our current assets towards the top, cash being number one, right? Current assets are generally those things that can be converted to cash within 1 year. It includes things like marketable securities, right? Our accounts receivable, an allowance for bad debts. We set that aside because we understand that, if we have $100 of accounts receivable, there's a good chance, 2 or 3 or 4% of that we might not collect on, right? And then inventory. Generally, we like to think that we can sell inventory within a year, right? Prepaid expenses are also kind of included as positives to our balance sheet. And investments in plant and equipment and those types of things become our long-term or fixed assets, right? We get to the bottom and we have our our total assets, right? And then on the other side, we have liabilities. And generally, if you look at a financial statement, you'll see that on the left-hand side is the total assets, on the right-hand side is liabilities, and the reconciliation of owner's equity. Okay. And liabilities are the same in that we have current liabilities, those that we're going to have to pay within 1 year. Okay, and those could be simple things. Accounts payable, obviously, would be one. Taxes payable, different payables like that. You can also include things in notes payable, accrued expense. Sure. It can also include things like the current portion of long-term debt. I might, and we'll, when we work on project one, we'll get into this, but I might have a loan for real estate, and it's a $100,000 loan, and I'm making $1,000 a month payments. It's going to keep it simple, right? So I'm going to pay $12,000 of that in the first year, okay? Although that $12,000 is broken down between interest and principal. Let's say my interest is $3,000, or I'm sorry, my interest is $9,000, my principal is $3,000. Okay, interest is going to show up on my income statement as an expense, but I would also on my balance sheet then I would show that $3,000 as current portion of long-term debt. That's the part of my $100,000 loan that I'm actually going to pay in that first year, and so it's actually considered a current liability versus a long-term obligation. And then shareholders' equities on the bottom of our right-hand side, or the very bottom of our financial statement, our balance sheet. Because remember, the accounting equation is assets are equal to liabilities plus owner's equity, right? And you can rearrange that if you want. You could say assets minus liabilities equal owner's equity, or assets minus owner's equity equal liabilities, right? Okay, so represents all these things. Preferred stock, common stock, capital paid in, and additional paid in capital, we might call that, and then retained earnings. What a balance sheet kind of looks like. Net worth or equity, okay, is now they've got net worth divided by book value. It's kind of interesting. Stockholder equals stockholder's equity minus preferred stock component. We're not going to worry too much about that. I don't know that we're going to discuss that at all because, again, not very many places use preferred stock. We'll talk about that why. Market value is of primary concern to a stockholder, securities analyst, financial manager. So what's market value versus book value? Because what we talked about here on our balance sheet, it gives us a book value, right? Total stockholders' equity is $700,000, it says right here, okay? That's our book value, okay? That's when we've taken our assets and depreciation, we've done all our calculations, our book value is $700,000. That may be completely different than our market value. So what's market value? Well, market value is what somebody's willing to pay for that company. And we'll see in public companies that yeah, it comes up a little bit later, so I think we'll talk about it there, right? Limitations of the balance sheet. Most values are based on historical or original costs. And again, with real estate, I think it becomes a little bit more difficult, because you'll have real estate that you've depreciated. At least the buildings and stuff you can depreciate. You can't depreciate the land, but you will have depreciated the buildings and whatnot, and yet it may have actually appreciated. And then it can be troublesome for plant, equipment, and inventory. The plant being kind of what we were talking about. Equipment can be kind of the same. You might completely depreciate an item, and yet it continues to have earning value for you for years and years and years, maybe decades, right? So it maybe still has some value, not unlike the real estate, right? FASB ruling on disclosure of inflation adjustments no longer in force. Inflation adjustments, that would be positive adjustments for plant and equipment and those types of things, maybe. You probably get into more complicated accounting there that you need to talk to Rod about instead of me. So the difference between per share values may be due to asset valuation, and this is per share versus book value. So again, we're talking market value versus book value here. Industry outlook, growth prospects, management, risk return, are we willing to take on more risk, those types of things. Here we go, comparison of market value to book shares, and we could look, some of these probably changed quite a bit, but ratio of market price to book value, and you see a high of 10. I guarantee you IBM's not at that right now, because IBM's been struggling in terms of its stock price in the last several months, right? And you come down, and some of these other ones, we saw the price to book for Nike was 7.1, and the price to book for Under Armour was quite a bit higher than that. Or maybe I got 7.1 was Under Armour, and Nike was quite a bit lower than that. But in any event, quite a big difference, right? In banking, one that I'm familiar with, the typical price to book was about 2. You could just about, and financial industry's old, right? Banking's old, on and on and on. It probably hasn't changed a whole bunch. If I looked up a bank, we're probably going to see a price to book of about 2. Okay, because again, banks don't change all that much. If you had a real up-and-comer or a growing one, it might be a little bit higher. An old static bank, like Wells Fargo or something, it might be a little lower, but it's probably not going to be too far off. So, if we had, if I can get my computer working fine, and if we have some time, we might go look at some price to books a little later. So, statement of cash flows, right? Critical nature of cash flow to the firm. Yeah. Represents cash equivalents, those things convertible to cash, on and on. Accrual method allows matching of revenues and expenses in the period in which they occur versus the cash method, right? And so we don't always get paid for things, and we don't always pay for things in the periods, quarter, monthly, whatever that may be, even annual, that they occur. And so we can use an accrual method instead to do some of those things, and accrual is probably used by bigger companies versus cash. And just to give you an example, for us at the bank, you knew what like property taxes and those types of things were going to be. And if our property taxes were going to be $12,000 per year, they're due in November and May. Okay, so maybe it was $6,000 in November and $6,000 in May, just to keep the math simple. But we would break it down, and we would accrue $1,000 each month, right? So that it would show accurately that those, that the taxes were actually for that particular month, even though it gets paid in November and May. The actual cash expenditure, though, would take place in November or May, and so the accrual on the income statement versus the cash expenditure on the cash flow, two different things, and we'll see that a little bit when we do project 1, kind of what the differences are there. Disadvantage of accrual method: adequate attention not directed to the firm's actual cash flow position. That's kind of right, and that's why we do a cash flow. Okay, that's why we do a cash flow, because we want to know where we're at. We might need to borrow some money in the short term, right? Maybe we have to pay our taxes and we don't have enough, and so we might have to borrow some money in the short term, even though we'd cover that in the next month or two, right? And we can also break cash flows down into this from operating activities. So that's just what we do day to day, buying goods, selling goods, okay, or providing services. Cash flow from investing activities. So we might have owned an interest in another company and have sold that interest, and we might get a profit or something from that, right? And so that's an investing activity. Those things happen. We get some interest income, different things like that possibly. And cash flows from financing activity. So we might go borrow a bunch of money, and that might give us a tremendous cash boost, right? But it's nice to know. So if you look at the bottom line, it looks wonderful. We have this huge increase in cash, but you need to break it down so that you can see that it actually came maybe from borrowing or whatnot. So, okay. And we'll look at cash flow. So determining cash flows from operating, kind of already talked about that. And direct or indirect method, depending on what you want to do. I don't think we get into that a whole bunch. We might look at some of that a little bit as we go through. Okay, we'll do examples of a lot of these, I think, as we go through our chapters 3 and on. Comparative balance sheets. This is, I believe, direct and indirect, or just from year to year. So it's not direct and indirect; it's year to year. And I love looking at balance sheets for this reason. I like to be able to see what's happened to that shareholder's equity. That's a huge deal. Cash flow from operating activities kind of tells you what went on there, right? Investing, borrowing money, etc. I'm kind of whipping through this. From financing activities. Oops, I'm sorry. The investing. What did it say? I said borrowing money. That wouldn't be true. Okay, investing might be from, again, having other investments in things, right? Or buying or selling some things, not your inventory, but other things that have to do. You might sell off a plant, right? You might spin off a part of your business, or those types of things might be investment activities. It could be also things like investments that you have. Microsoft sitting on $100 billion of cash, right? And it has money, obviously, that's coming in from that. Okay, financing is if we're borrowing money, or we may have a huge reduction in cash, right? You might go, oh my gosh, but when you look at it, you might find out it's because we prepaid a bunch of debt or did something like that, which can happen also, right? Sale of firm securities is a source of funds, so you can sell stock, is what that's saying, preferred or common, and you can raise cash, right? Raise money. So payment of dividends or repurchase of securities. And repurchase is kind of interesting because that's a huge deal right now. There's actually a whole lot of public companies that are spending a lot of money repurchasing securities. And why do they do that? We'll get to talk about that as we go along. So analysis of overall statement. How are increases in current assets being financed? Is it through retained earnings, or do they have to borrow money? Is there an associated buildup in current liabilities? So are we increasing our accounts receivable and increasing our accounts payable at the same time because sales and stuff are going up? Is that good or bad? All kinds of things that we got to look at. How are increases in long-term assets being financed? Again, are we able to do that with retained earnings, or do we have to go out and borrow some money, or maybe sell some more stock, right? Preferably adequate long-term financing and profits should exist to finance long-term assets. Yep, hopefully. Long-term financing, okay, you should always match financing with the assets. So if you're purchasing real estate, you should get long-term financing, right? If you're purchasing equipment, we'd call that more intermediate-term financing. And if you're funding like inventory, that's short-term, and so it should be funded with short-term money. Short-term funds can carry some long-term needs, but that can be a little bit risky. Some companies can do that though. If you're relatively rich anyhow, you don't have a lot of other debt. You might buy, if you're Microsoft, you might go buy a plant in India, right, that costs $3 billion, and you might take out a short-term loan just because you don't want to access your cash or something, right? It's certainly not risky in that case, but it really depends on each company. So depreciation, right? What's depreciation? Well, we call it a non-cash expense. It's certainly not a new source of funds. But we add it back to the net income to determine the amount of actual funds. And really, what the government's saying is that we don't get to, or what the financial accounting standard boards are saying is that we don't get to expense all kinds of items. In other words, my brother-in-law, that he can go out and buy fertilizer and chemical and that kind of stuff, right? But if he buys a tractor, let's say he had a huge year, right, and he made $300,000, and he says, well, I can offset that. I'll just go buy a $300,000 tractor and I can expense that, right? The government, the IRS says, no, sorry, Charlie. What you're going to do with that $300,000 tractor, you're going to put that on the books, and then you're going to have to depreciate that over the life of the tractor. And a tractor might last 10 years. And again, I'm really simplifying this, but so you get to deduct from your taxes $30,000 per year in a real simple, in a simple depreciation format. You get to deduct $30,000 per year. So if my brother-in-law made $300,000, he buys the new tractor, he only gets to depreciate $30,000, right? He's still got to pay taxes on $270,000. Okay, so that's you got to be careful of those things. Okay, and that's what it says here. It's an attempt to allocate the initial cost of the asset over a useful life, and that's true, right? It's also the government keeping us from expensing things. Again, that's one of those things that Congress likes to fiddle with, because in slow times, when we're kind of in recession and whatnot, the government might allow my brother-in-law, instead of putting that over 10 years at $30,000, they might tell him, well, I'll tell you what we'll do. We'll let you depreciate half the first year, and then the rest over the next 10 years. Okay, that gives a huge incentive then for people to go out and buy equipment in that case, because they can offset income. So charging a depreciation does not directly influence fund movement. I guess that's right. That was just a cash flow statement. Again, we'll take a look at lots of cash flow statements through the semester. So free cash flow, you'll hear a lot of people talk about free cash flow, right? Cash flow from operating activities minus capital expenditures minus dividends. And that's what a lot of analysts, stock analysts, company analysts, they kind of look at the free cash flow. To them, that's as important or more important than net income. Okay. Income tax, tax rates, corporate tax rates in the United States are the highest of any industrialized nation in the world. It's kind of interesting. And then we also, we've got a real punitive tax on foreign earnings. And that's why companies like Microsoft, Apple, Google, they've got billions of dollars that stays overseas. They don't want to repatriate it, because if they repatriate it, they have to pay taxes like 30-40%. Okay, they can leave the money overseas, and unfortunately, what they often do then is that then when the money, because the money's over there, they might invest it over there in plants, equipment, those types of things, and build up structures over there. I'm getting a little political there. I'm sorry, but and we're the only industrialized nation that charges a tax like that. So it's kind of a little bit disconcerting at times, and there's been a lot of talk, and I would guess that you'll see Congress in the next year or two kind of address that and maybe come up with some ideas for that. I don't know if the current administration would be acceptable to some changes, but we'll see. So, but corporate tax rates, corporations, C corporations are also double taxed, right? And again, we'll look at that double taxation. What do I mean by them being double taxed? Well, it simply means that if Microsoft makes money, and they do, right, they pay a tax. Okay, if they pay a dividend to me, guess what? I get to pay a tax on that dividend. And so we call that double taxation for a corporation. A sole proprietorship, an LLC, really any other form of organization, the taxes or the tax obligation flows through to the owner. Depreciation, it's a tax shield, right? It's not a new source of funds. It provides a tax shield. Sorta. Again, it's a tax shield that's deferred out over time, though, usually. And we'll spend a decent amount of time. Good, got through it. Thank goodness. So I said price to book, right? Yeah, Under Armour was 11.4, and Nike was what the heck were they, 7.1? something like that. Now you take a little more mature company. Actually, that's hard to think of Microsoft as being a mature company, but it is. And we'll see where it's sitting. Forward PE is only 14.4. Remember, Nike was 23.4 and Under Armour was 44. Price to book here, 4.3, right? So a whole lot smaller. Okay, but again, growth prospects for Microsoft are probably smaller, just because it's such a mature company, and that whole computer game is kind of mature and also changing. We're going from PCs, which has been Microsoft's haven, to other forms. Okay, yeah, so it's kind of interesting. Now, I think I said, what about banks? Let's look at the price to book on banks, see if I was right. Gosh, I hope I'm right. Yeah, bigger bank, a little less than 2, right? It's like I was right. Yay, yay. Forward priced earnings just 11.5. So even less. That's why I say when you look at the whole S&P, the average comes out to 14 or so. Part of that too is keep in mind that it's a weighted deal, and so Under Armour is tiny compared to Nike, which is tiny compared to Microsoft. Okay, and so when you weight those, even though those guys have high price to earnings ratios, it doesn't affect the overall all that much, as much as a Wells Fargo would say does, or a Microsoft. Here's Wells Fargo has a market cap of $270 billion. So that's what the market thinks Wells Fargo is worth, versus going back to the smaller one that we looked at, which was Under Armour, has a market cap of $14.4 billion. So 1/20th, roughly the size of Wells Fargo. So yeah, huge difference there, right? Huge difference. So Microsoft would be up there, right, with Wells Fargo. I think it's actually a little bit bigger, if I remember right. So that's enough. I'm going to sign out so I can get this thing sent off to you guys here this afternoon. And so next week we'll get a little more serious into some of the quantitative stuff, and we'll also probably I'll start showing you some stuff for your Project 1. So thanks, and